Open your brokerage app or financial newsfeed on any given morning, and you are hit with a wall of data. Analyst upgrades, supply chain rumors, earnings whispers, and CEO tweets cascade across the screen in real time. We are taught that processing this constant stream of information is how you do rigorous due diligence. But the empirical data points to a disturbing reality. Investors who consume the highest volume of this financial news actually produce the worst market predictions. This inversion of information and accuracy was quantified in a controlled experiment at Michigan State University, led by Dr. Terence Pitre. Today, we are going to deconstruct the exact data from this study to see how excess information degrades accuracy. We will identify the specific psychological mechanism causing the failure and lay out a compliance-grade protocol to fix it. If you manage money professionally or actively manage your own portfolio, your daily habit of checking market news is a measurable cognitive handicap. In the modern financial ecosystem, the pursuit of hyper-information serves as a mechanism for cognitive failure rather than due diligence. To understand why intelligent investors fall into this trap, we have to look at the timeline of feedback. For a day trader, the feedback loop is immediate. They act on a bad headline, and they are financially punished by market close. Long-term investors operate in a completely different reality. When you make an allocation based on an analyst report today, you do not find out if you were right or wrong until the next quarterly earnings report drops, which is up to 90 days away. This 90-day feedback vacuum is dangerous. It allows you to consume daily news and mistake the resulting feeling of confidence for rigorous due diligence, completely unaware that your accuracy is dropping. The Michigan State study isolated this exact phenomenon by placing test subjects into a clinical setting and dividing them into two strict cohorts, a control group and a treatment group. The control cohort, which we will call the quarterly group, was restricted exclusively to a minimal 3-page earnings summary. They received nothing else. The treatment cohort, or the weekly group, started with that exact same baseline data. They received the identical 3-page earnings summary. But then the researchers altered the variable. The weekly group was bombarded with 156 additional high-frequency data points. This included weekly price charts, management press releases, analyst forecast revisions, and historical ratios. Standard financial logic dictates a clear outcome here. The group processing 156 extra data points should make vastly superior market predictions compared to the group staring at a 3-page summary. Take note of the weekly group's data diet. It perfectly mirrors the exact daily workflow of the modern financial professional trying to stay informed. This scatter plot shows the results. The quarterly group established a strong baseline of accuracy. Their predictions formed a tight cluster, adhering closely to the center line that represents the true valuation. Then the researchers measured the performance of the highly informed weekly group and immediately identified a massive failure in their error rate. The weekly group made errors that were 40% larger than the group operating with almost no data. The degradation didn't stop at the average error rate. The researchers looked at a second metric, the prediction spread. The predictions from the weekly group were 3 times more spread out and disjointed than those of the quarterly group. More information did not lead to clarity. It did not help the investors converge on the correct valuation of the asset. Excess data created intense internal disagreement and cognitive noise. The group operating with significantly less information won by a landslide. To understand why intelligent people actively degrade their own performance when given more data, we have to look at a behavioral finance concept called primacy bias. This timeline illustrates how exposure to early, intense information during week 1 forces the human brain to stubbornly anchor to that initial narrative. It creates a clear signal in your mind. But as weeks 2 through 156 progress, a massive influx of daily news arrives. You read analyst downgrades, you see CEO interviews, and you digest macroeconomic rumors that contradict your initial data. Instead of updating their thesis objectively, the investor uses the new data to second-guess themselves. The initial solid signal degrades into erratic cognitive static. You end up overweighting outdated, noisy commentary and severely underweighting the actual, recent primary data that determines the asset's real value. The quarterly group succeeded precisely because their sensory deprivation prevented primacy bias from ever taking root. They only possessed the latest quarter's facts. This academic finding maps directly onto the tools you use at your desk right now. look at your standard brokerage application. Specifically, locate the News tabs, the Analyst Ratings modules, and the Social Sentiment widgets. These user interface features are digital, highly amplified replicas of the exact weekly condition that caused the test subjects to fail in the MSU lab. Platforms design these dashboards to make users feel highly informed. That feeling of being informed breeds the exact overconfidence observed in the test subjects who made the largest errors. Engaging with your brokerage's newsfeed represents a choice to enter an ecosystem engineered to trigger cognitive bias and impair returns. To replicate the high-accuracy returns of the quarterly group, investors must adopt a strict, systematic data filtering protocol. Rule 1 requires the absolute deletion of all financial news aggregators, financial television networks, and social media market commentary from your daily workflow. Rule 2 dictates that your primary reading must be restricted exclusively to official, standardized SEC documents. Specifically, you read the annual 10K and the quarterly 10Q filings. Rule 3 implements a strict binary filter. If a piece of market information does not exist within the official SEC filing, you legally treat it as noise and deflect it entirely. Following this protocol requires you to digest a maximum of 5 highly dense primary documents per year per stock. Executing these 3 rules is the only empirically proven way to recreate the protective, high-accuracy environment of the lab's winning control group. For the registered investment advisors and fiduciaries in the audience, this protocol functions as a critical compliance mechanism. FINRA Notice 11-02 explicitly directs financial professionals to curb speculative trading driven by market news and rumors. Advising your clients to consume less daily financial news is now a legally sound fiduciary-grade recommendation supported by rigorous peer-reviewed university research. I built a 1-page 10K-only checklist detailing exactly what the winning group in the MSU study read and the sections they skipped. The link to download it for free is in the description. Stop reading footnotes and start reading filings. Make sure you subscribe because in the next video, we will deconstruct exactly how analyst price targets are specifically designed to weaponize this exact bias against you.